All right, Pops, it seems like the softening in the auto market is starting to hit some of the major dealers as well, at least a little bit. Interesting Q2 earnings reports have started to come out. You want to break down some of what we're seeing, Dad, and make sense of it for us?
Well, no, I can't make sense of it. You expect me to make sense of it? Well, what's going on is dealers are selling less cars. Their profits are going down a little bit. Their revenue's going down a little bit. But they're still making money, even though they're selling fewer vehicles. And as CarMax thinks that, well, inflation's part of the cause. And consumer sentiment is part of the cause. But even with the decline in sales, CarMax is well, by far and away the largest purveyor and seller of used cars in America today.
Let's get into this though for a second, Pops. Let's get into how much money they made per vehicle in the most recent quarter. So let's start with CarMax. CarMax actually saw their profit per vehicle go up to $2,339, an increase of $134 per vehicle sold. So you're right, profits went down year over year for that quarter. However, the profit per vehicle actually went up. If we look at our friends over at Lithia, Dad, they actually saw their gross profit per new vehicle increased 43% to $5,970 in the second quarter, while average gross profit on used vehicles fell 11% to $2,955. So a little bit of a mixed bag there, but I think it's primarily buoyed by a 43% increase in new car profit. That's huge.
The question to ask there is, does that $5,970 include F&I profit per new car? Because if it doesn't, and 2.5 years ago, the average front-end gross profit on a new car sold in America was $250 to $300. That would be just an off-the-charts increase that can only be reflected by additional dealer markup and their customers paying that. So my suspicion is that that's a combination of F&I and front-end gross. But even so, those are, can I say, crazy ass numbers? I mean,
I think it paints the picture, Dad, of new cars bought at non-negotiated prices from Lithia dealerships, AutoNation dealerships, the list goes on and on, are not a value right now because they're transacting at more than MSRP. We've known that for months now. The average transaction price for a new car is typically $1,000 over the manufacturer's suggested retail price. We know that from Cox Automotive. And this data from Lithia just blows it out of the water. They're making nearly $6,000 per new car sold. So yeah, sure, maybe their total profit is down or their total revenues are down. Their profit per vehicle has never been higher, which, Dad, honestly, these Q2 earnings, they scare me a little bit because they kind of foreshadow what the future could look like for the dealership, aka less inventory on hand, more profit per vehicle for the dealer.
Yeah, with less inventory on hand, they're always going to be in a shortage of supply and an excess amount of demand, which is what allows them to get away with these additional dealer markups and be able to sell at profit levels that they never, ever dreamt were imaginable.
And they're making a hell of a lot of money doing it. That's for damn sure.
Yeah, maybe we're on the wrong side of things. I don't know. Thinking about getting an extended warranty? Go to joinyaa.com and check out our pricing there. There's no obligation, no spam, no robocalls. YAA for your extended warranty.
All right, so Dad, another dealer, quite possibly the largest auto dealer in the United States, AutoNation, their earnings were down in the second quarter, but interestingly, that was because they actually purchased a finance company that's going to become their captive lender. An interesting story there.
Yes, their sales volumes were down, and so overall revenue was down. And they didn't give a breakout of profit per vehicle, but I'm assuming that it's still very strong. They had led the way in the first quarter, so I would imagine they're either still leading the way or at worst second as far as per vehicle gross profit. But the big news for them is that they've decided, their new CEO has decided that they need to get into the finance business. They need to have their own captive lender. And by doing that, they've already had the best back-end profits in the industry as far as F&I profits. If they own their own captive lender, I would imagine they will be the first auto retailer in the country to average over $3,000 per vehicle in F&I revenue, because they will own it from soup to nuts. And since it'll be their captive lender, they will be able to, forget about the loan-to-value ratios. They'll just be able to say yes.
Yeah, and so let's break this down just a little bit for everyone that's playing along. When you go to AutoNation to buy a used car, and this captive lending piece will primarily affect used car purchases, they don't expect to necessarily compete with the subvented rates that the captive lenders from BMW offer, Toyota offer, for example. But when you go to an AutoNation dealership, you can't negotiate on the used car price. There's no haggle, no negotiation on the used car price. And we already know they make a ton of money there. And now they're likely going to want to place you through their own captive lender, where you're probably not going to be able to, I mean, maybe you'll be able to beat their rate. This is why you should always get a pre-approval from a credit union, but they're going to try their best to force you into that loan. The money never leaves. Like, it goes from one AutoNation business to another AutoNation business to another. Like, they own, it's called vertical integration. They own the whole piece. As a consumer, there's not too much to be worried about, aside from the fact that you need to be able to be prepared to come in with other options. But just kind of bear all that in mind. And yeah, Dad, I agree with you. I bet you that manifests itself as a $3,000 back-end profit per vehicle a year from now. Obviously, they wouldn't be investing $65 million to purchase that CIG Financial if they didn't think they were going to make money from it.
And believe me, they will. They'll know how to leverage it. They are the largest retailer of cars in the country, the largest dealer group, publicly traded dealer group out there. There's only one reason they're doing it, and they see this as a way to be able to enhance their profits moving forward.
Yeah, I think you're spot on. All right, we will get more earnings results from dealers and also automakers over the next couple days and weeks. Big one to keep your eyes out for: Carvana, Dad. Their earnings drop the first week of August. Super interested to see what's going on there. Something tells me the reaction will not be quite as rosy as what we saw with CarMax. Yeah, we're not going to hold our breath on that one, but I'm looking forward to seeing it.
I'm pretty sure there's a lot that's going to drop with Carvana.
I'll stay tuned.